Coming up in today's show, stocks fall across the board as yields keep surging, the number of jobs available comes in higher than expected, why rates are likely to remain high, some say we're setting up for a crash, and how some hedge fund billionaires are betting in this environment. Hey guys, welcome back to the Click Capital Daily Market Show. And what an interesting day. Here on this Tuesday on Wall Street, we had some significant sell-offs today led by tech. As you can see here on the heat map, bit of a reversal from yesterday after they outperformed the rest of the market quite a lot. They then did a full U-turn and led the way down today. And there was quite a bit of bearish breadth across the board. Also in financials, which came off a bit. And the only two standout sectors was energy, which was pretty much flat. And we got a bit of a bounce in utilities after they've been slammed the last week. And here's a look at the year-to-date performance of all major ETFs. And you can see what's interesting today is the Dow Jones Industrial's actually gone negative on the year. However, we've still got the Nasdaq up a huge 33% year-to-date and SP 500 up 10%. And you can see the real standout sectors are semis up 40% and tech in general and discretionary still up 21%. With the losing sector, regional banks down 32%. And international stock indices are still mostly flat, up a little bit in Asia Pacific. And weakness in the defensive sectors like healthcare, utilities, and consumer non-cyclicals, all down on the year, in addition to fixed income with those rising yields. And so not helping the stock market today was the JOLTS job openings, coming in higher than expected, showing that there were 9.6 million jobs open at the end of August. That's an increase from 8.92 at the end of July, and well above expectations of 8.82 million. And basically what that's telling us is the jobs market's not cooling as much as the Fed and the stock market would like, showing that the labor market conditions still remain tight, and basically that means the Fed can't take their foot off the gas just yet. And so volatility is picking up in markets across the board here today, and that's because we've got the most important asset in the world, the US government 10-year treasury bond yield ripping higher and higher, as we can see in the chart of it here, getting up to 4.8% today. And like I've been saying lately, this looks to be going into potentially a blow-off pattern, in which case we could see it above 5% this week, and that's going to keep a lot of downside pressure on stocks and pretty much everything else as well, bond prices, commodities, as that's going to help keep the dollar strong. And so I think regardless of what the Fed does, the bond market knows it can earn a higher rate, and that's because nearly a third of all US government debt is set to mature in the next year, and they'll have to come back to the market to sell more treasuries so they can keep the country running and pay their bills, and that works out to a huge 7.6 trillion. And the reason the US government has to keep selling bonds to the market, it's simple math, they spend a lot more than they make. We can see that here in this chart of their revenue versus expenditure in 2021, in which all their tax receipts total a little over 4 trillion, and then they managed to spend 6.8 trillion, creating a deficit of 2.7 trillion. And so to fill that void, they sell debt to the market, and that's been an ever-increasing trend. And that's all been fine and well when interest rates have been super low. Over the last 15 years, they've blown out their debt. The problem now is interest rates are at 15-year highs and are currently ripping higher. And so their net interest component, which was recently at 352 billion, is set to overtake the national defense spending about 755 billion in the next couple of years. And some say within 20 years, net interest will be the biggest expenditure from the government. And so it doesn't take a genius to realize this is unsustainable. And just to put it into some context, imagine you are earning $40,000 a year from your job, but then you always spent $68,000 a year. And then to make up for that shortfall, you borrowed money every year. It's easy to see how that's just not sustainable in the long run without some big major changes happening. And whether consciously done by our leaders or forced upon them by the market or society in general, either way, something has to change in a big way. Otherwise, this could result in some dire consequences down the track, but most likely after current day politicians are long gone. Adding to the upside pressure in rates has been one of the largest buyers, if not the largest buyer and holder of US Treasury debt over the last 10-15 years, and that is China. And not only are they having big problems in their own economy, generating less tax revenue themselves to recycle into US Treasuries, they've also closely aligned themselves with Russia and others in the strong long-term pursuit of de-dollarization and trying to knock the US off its perch and remove its biggest advantage, and that is having a global reserve currency. And so China's sold $300 billion in treasury since 2021, and they're ramping up that trend and have sold $40 billion since April this year. And again, it's just simple supply and demand. The more buyers of treasuries, then the lower the yields have to be. And the same goes in reverse. When there's less buyers, the US government is going to have to offer a higher yield to attract that capital. And so while we talk a lot about interest rates, inflation, and Fed on this channel, is because rates are kind of the most important thing in financial markets. You could think of it as a huge gravitational pull on just about everything else out there, as most assets are priced relative to the US government 10-year yield. And so these moves in the market have big implications across the board and for society in general. And so you could think of as the US government over the last 20 years. It's kind of like a drunk consumer with a credit card with no limit. However, it looks like now bond vigilantes are coming out in force, and the chickens are coming home to roost, and it could get a whole lot worse. And that's because the stock market was hoping earlier this year the Fed could have declared victory on inflation by now and officially announced they're going on pause, and that we could see lower rates in sight. However, that's just not materializing. Instead, the market's coming to terms with the reality of higher for longer. And we've even got 2 Fed officials confirming that sentiment today. And while most of them think their policy is sufficiently restrictive to get to their 2% inflation target, anyone that buys gas or food knows that inflation is nowhere near close to 2% or coming back down. It seems more embedded and structural, and it really shouldn't be of major surprise considering the record amount of stimulus, record low interest rates, and the Fed creating a $9 trillion pile of artificial money to buy assets, creating the everything bubble, inflating assets to records. So some expecting all that to be flushed out of the system in under a year. I just don't think is realistic. And so persistently high inflation could hang around for quite some years yet. And so that's creating vulnerabilities in the banking system, especially regional banks, which aren't in the clear just yet, as a lot of them hold huge amounts of bonds on their balance sheet, and they're showing huge mark-to-market losses. And that's not a problem if they can hold them to maturity and get their principal back in full. However, the problem is, if any more of them or the system at whole spirals out of control and they have to get liquidated, then those huge unrealized losses become crystallized, and that causes a flow-on effect amongst bond and equity holders. And we can see that in the price action of the financial ETF XLF, as higher rates are normally good for the banks. However, financials are selling off like most of the rest of the market is in this move as well. And those ripping yields are helping to keep the US dollar strong, surging to its highest level in 10 months. As we can see on the chart here of dollar index futures in a really strong, persistent short-term uptrend. And just taking you out to a weekly chart, you can see we've broken above that 105 resistance level, and we look to be putting in a higher high here. And so even though we're probably due a short-term pullback, this could be moving back into a medium-term, long-term uptrend. And that's adding a lot of downside pressure on all things priced in dollars, stocks, bonds, and commodities. And so seasonally, September and October can be a volatile time for the stock market. And this is after quite a long period of calm, where we haven't seen big daily moves in the stock market this year. And we've actually gone 198 trading days without a 2.5% or worse daily percentage decline in the NASDAQ index. And you can see in this chart here on the orange line, there's only a few instances over the last 35 years where it's had a period of more calm than what we've had so far this year. And you can see that here in this weekly chart of the NASDAQ Volatility Index, VXN, which had been in a strong downtrend since we bottomed in October last year. However, that looks to have found support a bit below 20, and we finished today at 23.77. And just zooming out, that's still not really a high level compared to where we've been most of the time over the past 3 years. And some analysts are going as far to say we could see another 1987 style event in which stocks fell 20% on one day. And that could happen again if the bond market does not cool off. And there's a look at the S&P 500 from 1987, in which you can see up to mid-October was having a pretty good year, but things peaked out in mid-August, and then come the 19th of October, it did a huge waterfall crash before eventually finding support over the next couple of months. Others like Bank of America are saying we do need that crescendo of panic selling and capitulation to make for a good bottom and bounce in the markets, and we're not quite there yet. And it's true, just looking at the weekly chart of the VIX, we're still under 20 today, and just zooming out again to a monthly chart, you can see it's nowhere near spiked as much as it normally does when we do see a bottom. We'll normally see a spike above that 35-40 level on the VIX, and same deal in the SKU index, which measures the price of out-of-the-money put options on the SP 500. Normally that will bottom out as well, and that's still a bit elevated at 129. And just looking at a regular daily chart of the S&P 500, you can see the market last week has been trying to find a short-term bottom here. We just took out last week's low today, and so even though we could be nearing a point of a short-term bottom in the market, it's still anyone's guess how much further this can keep sliding, and it could still go into that capitulation kind of sell-off before we do find a short-term bottom. And I can also see my market risk on off indicator has gone back into risk off mode today, and that looks at a bunch of things underneath the hood of the market, not just technicals. It's looking at breadth, volatility, term structure, and other things like that. And a spread chart you can look at to see whether the market is close to going into a crash mode is the term structure of the VIX futures market by looking at the front month contract versus the second month contract, and that's close to going above break even. So basically the volatility market is normally in a state of contango, and that means you normally got the VIX 30-day higher than the 9-day, the VIX 30-month normally higher than the VIX 30-day, and the 6-month normally higher than the 3-month, create an upward sloping curve. And that's because we know going out in the future 6 months we're likely to get some sort of correction, and so the market prices that in by making insurance further out into the future a bit more expensive. However, what happens in times of panic is you'll see the volatility term structure go into backwardation, where you've got up the front numbers higher than out the back, which we're already starting to see in the VIX 9-day, just a little bit above the VIX 30-day, and then pretty flat looking at the 3-month and 6-month. And so when that front month fixed contract goes above the second month contract, that can mean the market is getting a bit antsy. And we can also see volatility in the bond market starting to pick up as well. The MOVE index at 141, which had been downtrending for the last 6 months. And so when the market gets into this pattern, it can get a lot worse really quickly. However, we're not quite there yet. And just looking at the S&P 500 equal weight, it's a lot worse of a picture. You can see that selling's been a lot more stronger across the market. It's really just the mega cap tech holding up the big indices. And just zooming out on the equal weight index, you can see this market's been in a sideways pattern for over a year now. And even though we're likely to get a short-term bounce here, this kind of price action does technical damage to kind of the medium-term trends of the market. And why I continue to say we're neither in a bull or a bear market, it's just a sideways market. However, some are saying it's not all that bad. There is a bright side of higher bond yields, with the first point saying yields are higher but not particularly high. Since 1962, the average daily 10-year Treasury yield was more than a point higher than now, 5.9%. So really yields are just moving back towards normal. And second, that's a good thing for savers. A lot of boomers and retired people have a large portion of their wealth in savings accounts and short-term bonds, so they're going to be earning a higher yield, which helps their income. And the third point is higher yields don't have to be painful for stock investors, because from 1985 to 2005, inflation-adjusted bond yields were higher than now on average, and stocks during that stretch returned 15% a year. And we've got others like hedge fund manager David Einhorn is saying inflation protection is still the way to go by buying things like TIPS, which are Treasury inflation protected securities. And basically that's a bond where the yield you get is adjusted on the inflation. So if inflation goes up, you get a higher yield, and if it goes down, you get a lower yield. We've also got another billionaire bond investor, Jeffrey Gunlock, saying it's T-bill and chill time, who said for years investors face no alternative to stocks in an ultra-low interest rate environment, and it was hard to earn 5% annually on a bond portfolio. But he said now clearing that hurdle couldn't be much easier. A 6-month Treasury bill currently yields just under 5.6%. And it's true, here's a clean monthly chart of the US 1-year government bond yield, currently at 5.49%. And that for the first time in 15 years is a lot higher than the yield you can earn in stocks, both earnings yield and dividend yield. You can see for much of that past 15 years, government bond yields have just been super low. After that brief rip we got up in 2018, only got to 2.5%. The stock market did sell off hard in that time. Then the Fed came to the rescue again, and rates were already dropping going into COVID, and then hit absolute rock bottom after COVID, along with Fed liquidity and government stimulus sent the stock market ripping higher. However, we're not trading the past, we're trading the hard right edge of the charts, and here we are today with the highest yields we've had in 15 years. And so even though not much has changed in the market's probabilities of where the Fed's going to be going out into the future, it seems to have a mind of its own now, with these increasing yields and more of a spotlight coming into US government debt and how much they need to refinance over the next year, on top of things like corporate refinancing and big buyers like China not wanting to buy as much US Treasuries, and still embedded sticky inflation that's going to keep upside pressure on yields. However, technically speaking, we are setting up for a short-term bounce. That's because we can see the fear and greed index now in the extreme fear zone at 17, and the market will typically bottom on fear, and I can see that in my own custom indicators as well. Dark pool percentage at 59%, still not a huge reading, just slightly in the bullish zone. And the S&P 500 oscillator at 37, which is in the oversold zone. However, that's not as deeply oversold as it has gone in the past. And so I'd say we're getting close to making a short-term bottom. However, that doesn't mean we can't have that big sell-off capitulation day before we actually do put in the bottom. And the market will just be paying close attention to those 10-year yields and whether we get a blow-off top in that, because that's likely to coincide with a blow-off bottom in stocks. So the market's sliding pretty hard now, and that could pick up over the rest of the week. And I'd say if the 10-year does start getting up to 5%, we may see Jay Powell come out and try and cool the market down, maybe with some dovish talk or just hints of ramping up liquidity or anything just to kind of settle the market down and change its tune a bit. Then we'll most likely get the pullback in yields and the bounce in stocks. But like I said, even when we do get that short-term bounce, that is still some technical damage to the medium-term trend of the market. And just taking you across the rest of the market today, we've got stocks making new lows, blowing out to 228 at the NYSE, 238 on the NASDAQ, bit of a sharp move down in high beta stocks versus low volatility stocks. And this is creating a great environment to short stocks in. We can see that in my only bears strategy, which only takes short positions in US stocks and that's up 41.7% year to date, and it's quickly becoming one of the best strategies available on the Collective 2 marketplace. And if you're interested in following my trades and seeing what stocks I'm shorting, then click the link below this video and you can check it all out and learn more. And if you're interested, there's a coupon code where you can get the first month for free. There's a chart of inflation expectations still moving higher, and we've got global government bond yields still moving higher as well, with the EU 10-year just sitting under 3%. And the other big buyers of US treasuries out there, the Japanese, their government bond yields have been moving higher as well, as over the last couple of months their government has become less restrictive on keeping a cap on their yields. And even though they're still ultra low, below 1%, the higher they move up, the more likely the Japanese are going to keep more of their money in their own backyard instead of farming it out to the US government for their yield. So basically, as global yields rise, that keeps upside pressure on US treasuries as well. And there's a look at the daily chart of TLT, and that's getting really oversold down here. We just fired off the third consecutive reversal signal, minus 20 on the DSI, which is a huge oversold reading. And like I said, we're just nearing those capitulation levels because we're getting a lot of headlines in the media and everyone talking about it, and that's typically when we're going to get a bounce. There's high yield corporate bonds breaking down as well on huge volume, taking out another key support level today. And the next major support we've got is from those September, October lows last year. And so commodities are having a pullback now, but still holding up pretty well considering their environment. We're looking for gold to find support around here, 18.40 an ounce, and crude still holding up pretty good. Over to stock sectors today, every sector finished in the red except for two. That was gold miners, which finished slightly higher, and utilities. After that huge sell-off yesterday, we actually finished the day 1.1% higher, and this looks primed for a bounce as well. Over to popular stocks, we've got Apple just still holding that support zone at 172, and Microsoft approaching multi-month lows, and others like Amazon and NVDA still kind of drifting sideways. Tesla as well calling up on low volatility. Meme stocks were down hard across the board as you'd expect on a day like this, and there's Walgreens, which actually finished a little bit higher again today. Bit of a pullback in Sphere Entertainment, and the cruise ships look to have turned course and now in a solid downtrend. There's another stock we've been following, Celsius Holdings, which I'm also short in my Only Bears portfolio. That finished today down another 7.4%. And those vulnerable regional banks are starting to look a bit weak again, along with the big guys continuing to sell off pretty hard down here. Okay, so there we are on the S&P 500 index, finishing the day at 42.29. Looks to have just taken out that big trend line by just a little bit here. And like I said, the markets are sliding here on these ripping yields. We could still have that big capitulation day. Doesn't look to have got there yet, just looking at the VIX index. We'd have to really see that blow out above 25 at the least, maybe 30, to put in a good solid short-term bottom. We're just looking at a clean weekly chart of the S&P 500. If we do get that type of move, that's going to be damaging to that uptrend we've had since October last year. And at best, we're back into the kangaroo market, up and down sideways. So until then, we'll just be keeping an eye on that government bond 10-year yield. And if we do get that blow off top, I'd say we'll probably get some fresh commentary from Jay Powell, kind of stepping in just to cool things down. Then we should get a bounce in stocks if that were to happen. All right, that's it for today. Interesting times in the market, that's for sure. Thanks for sticking with me and Click Capital, and we'll see you again tomorrow afternoon. Cheers.